What if I told you that the high monthly income you're getting from your covered call ETF could be a ticking time bomb for your tax bill? Most investors think that dividends are a straightforward stream of income, but with covered call ETFs, what you see isn't always what you get, especially when it comes to taxes. And today I'm going to show you how to read between the lines in a clear and simple way so that you can keep more of your hard-earned money. And if you're new to our channel, hi, I'm Stefanie. Welcome to Permission to Be Wealthy, where me and my husband Joseph have open and honest conversations about what it's like to build wealth, invest, and pursue financial independence with balance, which includes a multi-six-figure account that's focused purely on covered call ETFs to fund part of our expenses as a family of four right here in beautiful Portugal. Today, we're tackling the big, scary monster of taxes for covered call ETFs. We're going to cover how qualified versus non-qualified dividends are taxed, how return on capital works, how 1256 tax treatment can be super beneficial, especially for high income filing investors, and stay to the end where I'm going to simulate how return of capital could impact a $100,000 investment in SPYI, which will help me show you how important it is to have a clear plan for your covered call ETF investments, especially which accounts you hold this investment in, especially if you're a long-term investor. So first, let's distinguish between what qualified and non-qualified dividends are. Qualified dividends are the efficient kind. These are essentially payments that you receive from a company's profits, typically when you own their common stock. One of the core parts of qualified dividends is that they are profits that are taxed already, which makes them qualified. Think of dividends from solid, established companies that you might find in an S&P 500 index, things like Johnson & Johnson or an ETF like VYM. The big advantage with qualified dividends is how they are taxed. They get those favorable capital gains rates, which you can see on the screen could be as low as 0% or 15%, or for higher earners, 20%. But I want you to notice that wide 15% tax bracket. For a married couple filing jointly, that covers incomes from nearly $97,000 all the way up to $600,000. That's a significant amount of income that taxed at a much lower rate, which is why these are often preferred by investors. Now, on the flip side, we have non-qualified or ordinary dividends. These dividends, for various reasons, don't meet the IRS's rules for those favorable lower tax rates, like dividend distributions from non-US companies, companies not listed on the US exchange, or income made from hedging, like premiums typically found within ETFs that write covered calls. And here's the crucial connection for our covered call ETFs, like QYLD or its G equivalent. A significant portion of the distributions that you get from these funds are considered non-qualified. Why? Because a lot of that income comes from option premiums, not traditional profits of the underlying companies that are already taxed. And this is a fundamental difference that you must understand. When it comes to taxation, these non-qualified dividends are treated just like regular earnings, your salary, your wages, or any other ordinary income. That means that they're taxed at the higher ordinary income tax rates. And as you can see in this chart, your ordinary income tax rates can be significantly higher than the qualified dividend rates that we just discussed. And here is the kicker. The dividend premium income from your covered call ETFs get added on top of the other ordinary income when calculating your total tax bill. So if you're already in a higher income bracket, this extra income could push even more of your earnings into those top tax tiers. Or if you're retired and planning for this income to supplement your living expenses, your ordinary income tax bracket will be something that you need to contend with when it comes to tax time. So now let's talk about return of capital, or ROC. A return of capital is a payment to an investor that represents a portion of their original investment rather than a distribution of income or capital gains. So I want you to think of this as getting some of your initial money back. So one key distinction is, unlike a dividend from a company's profits or a capital gain from selling an asset at a higher price, ROC is not considered taxable income at the time that you receive it. So when you receive a return of capital, it reduces the cost basis of your investment, and that cost basis is the original value of the asset, like a stock or a share of an ETF, used to calculate the capital gain or the loss whenever you go to sell it. So for example, if you buy a share for $100 and receive $10 ROC, your new cost basis for that share is $90. And while the ROC itself isn't taxed whenever you receive it, it can lead to a larger capital gain or a smaller capital loss if you eventually sell the investment. And this is because your cost basis has essentially been lowered. Once your cost basis has actually gone to zero, any subsequent ROC payments are then taxed fully. So like with the original example of the $100 share purchase and the $10 dividend classified as ROC paid back to you, if the NAV reduces to $90 and never goes up, and let's say the next year another $10 dividend premium is paid as ROC and the NAV goes down to $80 and so on and so forth, that is a straightforward example of bad ROC. However, there are some examples of good ROC that are really worth understanding. And the first is within covered call ETFs. So let's assume that you invested $100 into a covered call ETF at $100 per share originally. This fund has millions or billions of dollars of assets under management and is writing and executing call options that are generating both gains and losses within the fund. So for the sake of this illustration, let's say that there's $20 in gains and $10 in losses in year one. The fund managers know that losses can be harvested or carried forward indefinitely or used in the current period. So let's keep it, say in this example, we're gonna use it in this year to keep it clean. And we're gonna marry the loss with the premium paid out to the shareholder and classify that as ROC. So this helps the investor reduce their taxes in the short term. Assuming that you're gonna hold the investment for the long term, with the now larger capital gain can qualify under a long-term capital gain tax structure. So if I extend this example out 5 years, let's say the NAV of this investment is still $100, but the adjusted cost basis is now $60 due to the ROC classifications over time, making the capital gain whenever somebody sells this in year 5, $40 long-term versus flat like the NAV is gonna actually suggest. If you look at some REITs, you're gonna also find that they pay some or all of their dividends as a return of capital, and they do this because they can account for real estate depreciation and amortization of financial fees, which count as expenses or losses within their fund structures. And lastly, one that was really interesting in all of this research is fund managers have a choice on how they want to classify distributions when it comes to distributing ROC. And first, let's simply lay out where parts of a fund sit. A fund's capital is the initial investment in any unrealized gains, and then the parts that sit on top are net investment income, premiums or dividends as an example, and realized gains, sales from shares tied to calls as an example. And Fidelity lays out 3 scenarios where closed-end funds may need to choose to distribute ROC on the initial investment part. First, it could be that the fund is simply passing through return of capital from its underlying holdings. So for funds of funds, this absolutely makes sense. Second, a fund may have unrealized capital gains in the portfolio, and the portfolio manager doesn't want to sell a holding just to meet a distribution commitment. This is constructive return of capital because the portfolio manager is theoretically at least continuing to invest in the fund's total return instead of just for meeting a distribution. So said another way, pulling from its actual asset value versus generating distributions from other forms of funding. And in the third scenario, a fund simply may have hit a rough patch, but the board of directors doesn't want to reduce the distribution. So distribution reductions typically result in a share price decline, and so directors are usually adverse to reducing them unless there's a clear and compelling reason to do so. Honestly, this is not the ideal situation, and this one goes back to the bad ROC scenario. But the Fidelity article goes on to say that in some cases, this ROC could be wiped out even within a year, so you may not even see it in a 1099 statement at the end of the year. It's something that you want to be aware of overall. So now that we're through ROC, let's talk about 1256 tax treatment. In a way, this one was a bit more straightforward for me whenever I put it on paper. 1256 tax treatment is a tax rule that applies to specific types of contracts like futures and options and broad-based market indices like the S&P 500. This rule gives you a big advantage known as the 60-40 rule. It means that any gains or losses from these contracts are treated as 60% long-term, 40% short-term, no matter how long you actually held the investment. So let's say that somebody makes $180,000 in adjusted gross income and they make $20,000 in income distributions qualified under 1256 tax treatment. Their $180,000 slot into the tax brackets here in yellow, and this additional $20,000, while that income has to sit on top of the $180,000 for tax purposes, it has the 60-40 blended rate applied to it, effectively reducing some of the tax exposure from 24% down to 20%, and 32% down to 25% for this additional income. Now, I know this seems kind of simple, but the point is to illustrate how these concepts work so that you can make a more informed decision when building your income-oriented strategy, and whether it's in your retirement execution plan or in your long-term financial plan. And if you're finding deep dives like this helpful, please like this video. It really helps other people like you find our channel. And don't forget to subscribe so you don't miss future income investing deep dives just like this to keep you on track towards making eyes wide open investment decisions. So now let's get into our simulation for today. We're gonna take the popular investment like NEOS's S&P 500 High Income ETF, SPYI, and simulate the impact that ROC would have on a $100,000 investment. If we look at some of NEOS's latest details, we can see that the share price is $51.71, an annual dividend of $6.15 being paid out, 11.89% dividend yield. And I took a look at the latest tax notices that NEOS has communicated on its distributions, and we see that 94 to 96% of the distributions are actually classified as ROC. So if we apply 95% as our assumption on ROC in this investment, then that means that this investment's cost basis adjusts down a little over $11,400 per year. And if we take that forward into the future, that would mean that our adjusted cost basis would go down to zero and hit negative in year 9. Keep in mind, this doesn't account for any appreciation or decline in price. This is simply a straightforward example to illustrate how this could work over time on cost basis. So what does all this mean? 95% of this investment's dividend premium income isn't taxed in the short term. If you hold this investment longer than year 9, the income will have to be taxed because you can't receive any additional return of capital classifications. If you decide to sell after 365 days of holding this investment, you'll pay capital gains on the gap that ROC creates between your original cost basis and the now adjusted basis. You'll be paying long-term rates, and you want to make sure that you understand what limits you want to keep in place to avoid any unnecessary taxing. And this brings me to tax-effective strategies. If you're planning to hold this investment over the long term and reinvest the income, accounts like 401ks and IRAs are great options since these are providing tax sheltering for your investments. Just keep in mind that you have to pay the taxes at the point of withdrawing after 59.5. A Roth IRA is going to do the same tax sheltering, and you get a bonus. You don't pay taxes on your distributions in retirement, assuming that you are 59.5. And for those who must use a taxable brokerage account, you have to be smart. Choose ETFs with Section 1256 tax treatment. Embrace the ROC, but understand its impact. ROC is your friend for now, but you need a plan for when that cost basis hits zero. It's not a set it and forget it investment. And some covered call ETFs have negative total return, even with positive distributions, creating a perfect opportunity for tax harvesting. It's a little bit more of an advanced concept, but it's worth taking a look into. And remember, your financial plan is unique. It's not about being an accountant, but about understanding the rules of the game so that you can make informed decisions and ask the right questions when working with professionals that are helping you plan. Don't let taxes silently eat away at your returns. Remember, I keep the exact spreadsheet I use to build the data and illustrations for this video linked in the description below. I also include some of the resources I use to do my stock research and the white papers on topics in these sheets to help you further your research as you're getting more informed. And if you need a partner to help you map out your unique scenario or want to build a truly tax efficient portfolio, consider checking out my Financially Fit mentor sessions. That's also linked in the description below. And remember to like and subscribe so we can keep having real, honest, and balanced conversations about what it's like to give yourself permission to be wealthy.